Welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Monday, December 18th, and Dr. Orphe Divounguy, PhD economist, is, of course, with me. Dr. O, this is a pretty big week for reports, data, and information coming out. We're going to get, a handful of things that are going to drop into our lap. What are you most looking forward to?
What am I most looking forward to? That's interesting. I got to say, look, I'm excited about the holiday season and looking forward to housing absolutely killing it in 2024. That's what I'm excited about. That's all I think about right now.
Yeah, I get that. The data reports on the horizon, though, in this coming week. What's coming out, and what are you looking for? What are you?
Well, I'm looking at the National Association of Home Builders will report builder sentiment for November. It's probably still going to be not so great, but it's definitely going to be better.
Right,
it's going to be better than October, that's for sure. Right, as mortgage rates have eased somewhat, I expect builders to feel a little bit better about the future. I think anybody involved in the housing sector, working in housing, to feel very good about prospects going forward. Housing starts and building permits estimates from the U.S. Census Bureau are expected to show another month of mild decline.
Just real quick, a data point, worth mentioning, because, we gave it a lot of attention as it was going up. But per Freddie Mac, that 30-year fixed rate mortgage as of Friday, and just looking at it now on Monday, December 18th, 6.95%.
Yeah.
So under 7.
That's right. And again, I've talked about this to a lot of people. I said, look, soft landing scenario doesn't mean mortgage rates are going to fall off a cliff. They're not. Don't expect mortgage rates to keep coming down. They're going to ease a little bit. They're going to stabilize somewhere. And as inflation moderates further, you're going to get maybe less crazy market reactions and less rate volatility. But that's about it. And that's enough. That's good enough. Right? So we got mortgage purchase applications on the rise. So of course that signals new home sales. New home sales are likely to continue to increase. There was a little bit of a dip in October. Totally normal. October dip was both, seasonal stuff, but also the increase in mortgage rates. We hit 8% mortgage rates in October. So that was absolutely crazy. That's come down somewhat. It's come down a full percentage point plus in the last month. And so I expect new home sales, even if they were maybe flat or slightly negative, to come back roaring at the start of 2024. First in December, but also at the start of 2024. Existing home sales probably expected to be to still fall, to be negative on the month. According to our own Zillow data, the flow of existing homes coming on the market is now just 14% below the average pre-pandemic level, compared to 35% to the 35% shortfall in April, which means that even though existing home sales may have declined again, that because new listings, the flow of existing homes coming on the market is increasing again at a slow pace, but still positive gains. Like we're starting to see these gains, these people coming back on the market, especially relative to last year where they just sat out completely. Well, that progress, that improvement on the new listings front means that existing home sales is likely to improve. We know demand is going to be pretty strong, right? Because of all the factors I highlighted, demographic factors, real wages improving, financial wealth improving. And so it's just a matter of whether or not existing homeowners are going to want to sell. Are they going to want to give up those low mortgage payments? And for that, I say, look, there's a ton of Americans that actually own their house outright. And those people are coming back, right? There's a lot of people who also were waiting on the sidelines because they were like, well, rates are high and they're moving a lot and there's a lot of uncertainty about the future. So I don't know what to do. And now they're seeing, hey, my job's pretty secure. The labor market's pretty strong, right? Mortgage rates are easing a little bit. Maybe they're not going to continue coming down all that much. So I'm going to go back in, and they're starting to come back in. So we're starting to see that. And so I think even though existing home sales continue to decline through the end of this year, we might see a small rebound into the new year in 2024.
Yeah. So I mean, there are a lot of people that obviously fired up about what's gone on with the stock market. The Dow's had, as of the open today, I believe it's 7 consecutive weeks of wins.
All-time highs.
The numbers. I mean, the numbers are. They're favorable, right? How long can this last? And I mean, you can't forecast an entire year. But man, it seems like the trend's your friend until it's not. Yeah. This seems way too hot.
This was caused by a major, what I call overreaction by the market to the Fed last week, right? So the Fed comes out and says, hey, inflation's moving in the right direction. And so because inflation's moving in the right direction, we're going to hold the line. But they actually, in their summary of economic projections, started penciling in potential rate cuts, right? For next year. And what's crazy about that is that there's nothing crazy on the Fed's end. I think the Fed is doing the right thing in the sense that, look.
No, you're talking about the reaction side of this.
Or the interpretation expectations of forming that it's the job, a good Fed is looking ahead and managing risks and saying, look, inflation's come down. We don't want policy to become too restrictive and cause a recession. So a good Fed is going to start thinking about its forecast that way. And so they pencil in their forecast, and their forecast is what caused the market to overreact. The market is now penciling in 6 rate cuts in 2024. The Fed is talking about potentially 2 or 3 rate cuts, just adjusting policy so it's not too restrictive, so it doesn't become too restrictive. And again, the Fed chair comes out and says, we're going to wait and see what happens. But this is kind of the individual forecast of members of the FOMC. And the market went crazy with this. So much so that if you think we're going to have 6 rate cuts in 2024, then you're essentially predicting we're going to be in a recession next year. And so that's not actually good for Wall Street either, right? If you really think we're going to get 6 rate cuts next year, then you're saying we're going to be in a recession. If that downturn, that decline in economic activity, it does not materialize, and we start to see stronger and stronger number, or we start to see disinflation stagnate a little bit, then the market will correct.
Well, I mean, the way that it worked out, the way up, to the borrowing, the Fed borrowing rate that we have now was a 20-month process? Was it 20 months of steady growth? And now, we've sort of hit this plateau, and everybody's feels like they've got a good understanding of the ground, and now we're going to take some stair steps down. I mean, the Fed said 3. I've heard analysts
they didn't even say it, right? It's just the individual, right? The individual members. It's hey, I look at the activity, and this is what I'm thinking, right?
This Fed group, though, has telegraphed a fair amount of information. So I think that maybe that the number 3 in terms of the number of cuts, since that's been sort of either mentioned or included in Fed notes. I mean, I'm not saying that that's gospel.
They were thinking about it. If you look at the summary of economic projections back in June, I think, what it was, I can't remember. Two cycles ago. It was essentially it was similar to this one. This one includes an extra cut, and then they changed it. They raised it in September when they realized that economic activity was too strong, right? And they revised it up. So they do that all the time. They make these revisions all the time. Right. And they change the revisions based on the information they have at the time. And so it's what I think is absolutely interesting. And the market usually runs with it, but doesn't run that far. I think there was a lot of pent up anxiety, people waiting for the cycle to be over, to have some confirmation that the Fed would not be raising anymore and that the Fed would be prepared to cut, and that anticipation is what caused investors to go absolutely crazy. And unfortunately, financial and credit conditions are easing rapidly as a result of that. And what that means is the process of disinflation could slow. We may not get we may not get inflation declining in a straight line. And that means that potentially the market could react in the opposite direction, right? And that, right? So, but anyway, if in fact, if the Fed is acting because it's taking into account, remember we talked about headwinds and tailwinds in a previous podcast. Well, if in fact the Fed is anticipating the same headwinds that I was referring to, right? And maybe deliberately, right, trying to ease conditions so that we don't enter into a recession because they believe the headwinds in 2024 are going to be pretty strong, then that's good news, right? Then that's great. But a market that's expecting 6 rate cuts when the Fed is only hinting at 3 and the Fed might not even deliver 3, right? Could mean a correction.
Yeah, I mean, and I would say, like, you know, that it's anyone's guess. But I think it might be fair to say that at this point, it's anyone's guess. I mean, there are a lot of factors that could pull the levers up or down. We could get more cuts. We could get fewer cuts. We could get an increase.
Well, I don't think we're going to get an increase. Let's not go that far, Chris. I don't think we're going to get an increase. And the reason I don't think we're going to get an increase is because inflation expectations are falling and the labor market's still cooling. So I don't think we're going to get an increase. But I really believe that we may not see those rate cuts at the start of this year. For example, the PCE price index comes out next week, and I don't think it's probably going to be flat on the month, right? And it's, you know, core PCE is probably going to be flat on the month. Headline PCE is coming down because we get some supply chain improvements. We got energy prices falling, all that stuff. But core might not be moving down fast enough. And so if it doesn't, then you're not going to get that rate cut at the start of the year, right? Like the market anticipates. And by the way, for the market, let me just say this. If you believe there's going to be 6 rate cuts in 2024, then you believe we're going to be in a recession. And that's not good for Wall Street. It's just not. So I think, you know, I hear these commentators, analysts cheering the rate cuts. But let me put it this way again. If you believe we're going to get 6 rate cuts, it's because something's severely broken with the U.S. economy and that the consumer is struggling, and that's not good for Wall Street. And so that's what I'm going to end on. So I think the market could correct a little bit because give up some of these gains because it just went too far. And you're just overreacting to the Fed news.
Always great to be with you. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.
Are you tired of news that puts politics over people? At the nonprofit Franklin News Foundation, we believe in putting people over politics by delivering nonpartisan news and audio content that serves you, the American taxpayer. With Franklin News Foundation, you can read fact-based, state-focused news for free at thecentersquare.com. You can listen to civil, balanced conversations between policy experts through our podcast network at americastalking.com. Or you can get in-depth news on K-12 education spending, curriculum, and school safety at chalkboardnews.com. It's all free through Franklin, where we put you, the American taxpayer, first in every story, episode, and conversation. And it's only possible through our supporters. Together, we can produce content that puts people over politics and brings Americans the news they deserve. Become a supporter today at franklinnews.org/donate. Once again, that's franklinnews.org/donate.